Today we're going to talk about the concept of basis in income taxes. Basis is a very important concept, and if you don't know what your basis is, you could be subject to the IRS deciding that your basis is zero, and that, my friends, is not a good thing. So basis is basically the amount of the investment that you have locked up in a capital asset. I know that sounds like gobbledygook and lawyer speak. So let me give you an example. Let's say you buy a piece of real estate and you buy it for $200,000, and then you hold that piece of real estate for 7 years, and then you sell it for $350,000. Your basis in this example is going to be $200,000. Your sale price is $350,000, making that means that there will be a profit of $150,000 on that particular transaction. Now, your basis needs to be reported. If your basis is not reported to the IRS and included on your income tax return, the IRS is going to be receiving a 1099-S from your title company, your escrow company, the closing agent, however they handle it in your state. The IRS is going to receive this 1099 in the amount of the gross proceeds, and they're eventually going to send you a letter called a CP2000 where they propose to tax you on the entire gross proceeds. So in this example, the $350,000. And that is not a good thing. You need to report to the IRS. You need to keep track of what your basis is, and you need to include it on your income tax return. Every year, we have clients where we prepare their returns and they forget to tell us about a real estate sale or some other sort of asset sale, and then this comes up. So what else can apply to basis? Well, improvements on real estate can also be included in your basis. So let's say you buy this house for $200,000 and then you spend $100,000 on a pool. That $100,000 is not deductible, but it does get added to your basis. So now your basis in this house that you bought for $200,000, you put $100,000 in a pool. Now your basis is $300,000, and you sell it for $350,000. Then your gain would only be, your profit would only be $50,000, and you would only pay capital gains tax on the $50,000 profit. So it's really important that you keep track of this. My suggestion is going to be that, particularly for real estate, that you keep those receipts in some kind of cloud storage where you can always access them. You're never going to lose them. And see, these receipts can go back a really long time. So if you held the house for 35 years or something, you're going to want all of those improvement receipts, and you're going to be able to lay your hands on them in case the IRS disputes your basis calculation. It's important to know that basis applies to any asset. So you can have basis in stocks, bonds, cryptocurrency, cars. In theory, if you sell a car at a profit, which doesn't always happen, but sometimes it happens. I'm into certain old cars, and they actually increase in value. So you would have a basis in an old car. So you need to make sure that you keep track of this so that the IRS doesn't keep track of it for you, because if the IRS keeps track of it for you, they're going to decide that your basis was zero, and we just know intuitively that that's not correct. If you have questions about this or really anything else that has to do with taxes or tax planning, I invite you to visit our website at taxed.co.